Hey guys, today's video I'm going to be teaching you a little bit about mortgages. Where did they come from? What do they do? How have they changed over the years? And what leads them to where they are today? Let's get started. So in the old days, if you wanted to buy a house, you either had to pay cash for it or you had to go to your building and loan or your bank and say, "Excuse me, Mr. Banker, I want to borrow some of your money to buy this house." The banks would say, "Okay, well, based on your income and your equity and your investments, it looks like we can loan you some, but we'll only loan you up to about 50% of the home value. So you need to come up with a lot of it on your own." What else was a problem was that these terms for the mortgage, how long you had to pay it off, were only was about 5 or 6 years, after which the entire amount would come due. And the payments that were made on that were only on the interest of the loan. So you weren't actually getting very far in paying all the money that you owed back. These balloon payments would come due, people wouldn't be able to afford that, and sometimes they would lose their house. As time went on, they ended up creating the refinance, allowing people to change their terms with that same amount of money. And then the Federal Housing Administration came in and brought in some longer terms, 20 and 30-year mortgages that put most of the money toward the interest on the front end and then to the principal as time went on, actually paying it down. We still have the 30-year mortgages today. As time progressed, we also ran into the 70s and 80s, which had a lot of inflation and a lot of higher interest rates. This made your average home search a lot more difficult, especially on the qualification side of things. Mortgages were harder to come by. People couldn't swing the payments that were supposed to be due on standardized mortgages. But there was also an interest in private investment securities. Basically, however many mortgages are on the market, people are making money off that. So lenders were incentivized to push mortgages that were not good for people just to get them into a house. This led to the creation of what are called subprime mortgages, meaning that you have the standard that people ought to be meeting to make their home there, but they can't meet that. So we're still going to give them something that gets them into a house, creates a mortgage loan. These had adjustable rate mortgages, they had balloon payments, they had things that would wreck you when they came due. And that's what happened. Essentially, that's what caused the housing crisis. We had a bunch of mortgages out there, people that shouldn't have been in mortgages when they came due. We had a lot of foreclosures, bankruptcies. That's where all the inventory came from. That is why the levels of home value dropped so drastically. Bad people trying to make a bunch of money, putting people in stuff they shouldn't have been in. Nowadays, we have what are called the loan level pricing adjustments. After the crash, a lot of regulation got dropped on the mortgage industry in a hurry just to make sure that sort of thing didn't happen again. So nowadays, the loans that you're getting into are a lot better geared toward making sure they won't come back and bite you really that hard later on. You can still get in a little bit of trouble if you have the wrong ideas, the wrong lender, the wrong strategy, but overall things are a little bit easier to track. Things have been standardized, it's a lot more strict on what sort of guidelines we run into, but there are a lot of programs that still open the door to people that can't meet just the 800 credit score, 20% down, the ideal. A lot of programs that will still let folks in that are better regulated and don't turn you upside down once you're done with it. So if you have any questions, let me know. I'd be happy to help you explore your situation. Make sure you're in the best spot possible. Take care.